Well, despite uncertainty that rages over the tariff plans of the United States, stocks, as we just mentioned, are near record highs. Our next guest forecasts 15% returns in 2025, with most major markets around the world, he believes, delivering strong returns. Joining me now is Evan Mancer, President and Chief Investment Officer of Cardinal Capital Management. Thanks for coming in.
Yes, thanks for having me.
How should investors understand these markets where you've got persistent inflation in the United States, the possibility of it becoming worse through tariffs, the possibility of a trade war around the world, or at least in the Western world, hampering global economic growth, and yet markets continue to power higher?
Yeah, I think you've hit on the first part of the negative thesis that I think there's broad consensus on, that there's a lot of chaos and uncertainty, maybe more than normal. I mean, there always is, but maybe more than normal now. I think the more, counterintuitive consensus, and I would call it a consensus, is that the end goal of all these moves is to get to a spot where we have, at least in the United States, less taxes, less regulation, which maybe spreads to other markets like Canada, and then a bit more of a pro-business, pro-growth government. And so I think they kind of balance each other out. We still are feeling pretty good about the forecast. We think we can talk about more if you want about why we think we'll get through this tariffs in a relatively short period of time. And then, clients often say, well, you guys are always positive, and usually we are. Markets usually go up. But I think when we look at it, the two things that usually you do see in a negative market, recession and higher interest rates from central banks on the short end, we see very little chance of that. So hence, we're still positive.
Do you see any possibility of an interest rate hike in the U.S.?
No, we don't. I think I think right now they are, as you pointed out, a little higher inflation, like 3%, not way out of line, but a little higher inflation recently. And I think they've got, unlike Canada, the luxury of a very strong economy. They're probably going to wait and see the extent and effect of these tariffs on inflation. I think back half of the year, we start pricing in interest rate cuts again. If it hasn't happened, I believe Jerome Powell's his term comes up in, I think, May or March of 2026. And if it hasn't happened, I think he gets replaced with someone who's leaning towards cutting interest rates. That's certainly the view of the Trump administration.
Okay, let's go to some stocks that you follow closely and that are in the news today. The first one is one of Canada's big pipeline operators, Enbridge. That stock is down. It's a bit of a puzzle to me because I'm seeing a summary here of analyst reaction, and the analysts seem to be consistently saying that the company's EBITDA in the quarter was materially higher than their estimates. Do you have a sense of what the market is worried about in these numbers?
Well, actually, I was reading through it, and I actually like both. I read through Enbridge and TRAP, and I thought we'd be up a little bit today because I thought the results were pretty good. I think the big story of Enbridge is that this is the first quarter post their big gas utility acquisitions. Those seem to be done well. They're on track. As you said, earnings were up, so we thought it was pretty decent. Maybe the reaction is, if you go back a couple of years, Enbridge shares are up 75-80% over a couple of years, whereas they were trading very cheap. They're at the top end of their range, so anything other than maybe a solid beat, and they're down a bit. That's the explanation at this point.
Both of these companies, Enbridge and TC Energy, which you're referring to as TRAP by its ticker symbol, both of them have said that they don't see tariffs as material impacts on their business, which sounds intuitively correct. Is it to you that a pipeline operator which ships oil or gas across a border would not be affected itself? It doesn't own that oil and gas. It's not selling that oil and gas. It's transporting it.
For sure, yeah. When you see the higher gasoline prices and motorists complain about that and protest, they don't usually protest by consuming less of it. They protest that the price is high. Enbridge and TransCanada, it's all gas, but Enbridge on the oil side, they don't set that price. They're just moving it along. So we think other parts of the supply chain will take the hit if there's anything.
Okay, let's move on to a power distributor, Fortis, based in Atlantic Canada. It has reported fourth quarter and annual results, and that stock is higher today. And you like this stock as well. You have a buy on this one.
Yeah, we like Fortis. I think they really were firing on all cylinders there. I didn't find any weakness. I think they've got a fantastic business in their energy transmission with ITC. That continues to do really well. They've got, in Arizona, I think it's going to be a favorable rate decision for them. As long as I've been in the industry, they've been targeting that 6% EPS growth, and they extended that for the next few years. And so I think, Fortis is in a really good position. One of the fastest growing utilities out there. 6% doesn't sound like a crazy growth number, but for a really solid utility with a 4% dividend yield, we're pretty bullish on that company.
$1.6 billion in net earnings attributable to shareholders at Fortis compared to $1.5 billion the year before. Those are annual figures. 1.6 in 2024, 1.5 in 2023. Let's move on to Canadian Pacific Kansas City, one of our big railways. You actually call this one a top pick.
Yeah. I think that for investors, there's some worries about the tariffs. As just a brief history, they did purchase Kansas City Southern, so they've got one of the most exposure to Mexico. They've got a lot of cross-border trade in Canada, but we like it. We think all the rail companies are really solid long-term. The absolute infrastructure plays that you're going to need. We think CP is the best managed company in North America on the rails. And the growth, I think, will be spectacular over these next 5 years. They're targeting 12 to 18%, so probably more than doubling the earnings in 5 years. And we're not as concerned about the tariffs, as we already discussed, as maybe some other investors are.
The stock is down over the past 52 weeks, presumably on concerns about the North American economic backdrop. But I'm hearing you say you think this is a good entry point for longer-term investors.
Yes, yeah, we think it's a good entry point. Their results have been pretty strong, and I think as they realize more efficiencies, which I think they will do with this Kansas City Southern merger, I think we'll see that in the results. And from this stage, even if you just grow with the earnings and the multiple doesn't increase or decrease, you do very well with CP.